Risks arising from international operations. International operations introduce additional risks because organizations operate across multiple economic, political, and cultural environments. One major risk is political and regulatory uncertainty, where governments may change policies affecting taxation, trade restrictions, foreign ownership, or labor regulations. Sudden regulatory changes can significantly affect profitability or restrict market access. Organizations entering foreign markets must therefore analyze country risk carefully, including political stability, legal frameworks, and regulatory transparency. Strategies such as joint ventures, diversification across countries, and political risk insurance may be used to reduce exposure to sudden policy or legislative changes. Cultural and legal differences represent significant risks in international business activities. Management may fail to understand local consumer preferences, business practices, or employment expectations, leading to unsuccessful market entry or reputational damage. Cultural misunderstandings may affect marketing strategies, negotiations, and employee relations. Similarly, unfamiliar legal frameworks may expose organizations to litigation risks if they inadvertently violate local laws or regulatory requirements. Companies therefore rely on local expertise, legal advisors, and culturally informed management teams to adapt business practices to local conditions and avoid costly mistakes. Operational and financial risks are also amplified in international operations. Transporting goods across borders increases the risk of delays, damage, or loss in transit. Credit risk may be higher because collecting payments from overseas customers is more complex and costly. Furthermore, international operations expose organizations to foreign exchange fluctuations and interest rate differences between countries. These financial risks can significantly affect profitability if currency values change unexpectedly. Organizations manage such risks through hedging strategies, international credit controls, diversified supply chains, and careful financial planning to maintain stable global operations. Strategic and operational risks. Strategic risk refers to the possibility that an organization's chosen strategy may fail to achieve its intended objectives. This may occur because management misjudges market trends, competitor behavior, technological changes, or customer demand. Strategic risks often arise from major decisions such as mergers and acquisitions, market expansion, or product diversification. If the strategy is flawed, even perfect implementation will not deliver the desired outcomes. Organizations therefore analyze strategic assumptions carefully through scenario planning, market research, and competitive analysis to ensure that strategies remain relevant in dynamic business environments. Operational risk arises from failures in internal processes, systems, or human activities that disrupt normal business operations. Examples include IT system breakdowns, human error, fraud, supply chain disruptions, or inadequate internal controls. These risks typically affect the efficiency and reliability of day-to-day activities rather than long-term strategic direction. Operational risk management focuses on designing robust processes, implementing strong internal control systems, and establishing monitoring mechanisms. Internal audit functions also play an important role in identifying weaknesses and ensuring compliance with organizational policies and procedures. Strategic and operational risks are closely interconnected and must be managed together within an enterprise risk management framework. Poor operational processes may undermine strategic initiatives, while incorrect strategies may create operational pressures that increase failure risks. For example, rapid expansion into new markets without adequate operational infrastructure may lead to service failures or supply chain breakdowns. Effective risk management therefore requires coordination between senior management responsible for strategy and operational managers responsible for implementation. By aligning strategic objectives with operational capabilities, organizations can reduce risk exposure and improve overall performance.